Hi, friends. Welcome to the webinar. I'm just getting the microphone all ready so you can tell it's all live and on the go. Here we go. You'll want a pen and paper for this, and you'll also want your phone camera because I'm going to show you stocks and individual insights which are not going to be necessarily on the replay. Okay, so please make sure you're all ready. And let me know where you're from as well. As ever, let me know where you are from. And we'll kick off from all of that. Fantastic, Jacob can hear me. And I'm going to also, if you're not on my Telegram channel, I'll let everybody on my Telegram channel know where I am as well. And guess what? I think we should do this as a TikTok live as well. So I've got a heck of a lot to share with you. We're going to start with all of that. Now, let me tell you some of the things we're going to cover. Some of you have got big profits. What should we do about some of those gains? Which stocks still look attractive? What about any imminent falls? Is there a bubble? How do we handle that? How do we protect some of our gains? How do we manage our risk appetite to the volatilities and wobbles we might get, given that we will have some fear of falls and given that we'll have the greed to want to keep on to what we've got? How do we create a sliding scale of an approach? Also, for those who are holding pensions, how much growth are you getting? Is it enough? How do you decide how much to withdraw? What are the worst case scenarios? What are the best case scenarios? How do you improve growth? Why are IFAs letting you down? Which stocks look particularly attractive at the moment? What looks overvalued? What looks undervalued? Absolutely all of these things we will be covering. You will be pleased to know. So, as I said, get ready. And I'm also going to be answering questions. So we have got in the room people from all over the place, actually. I hope this timing's okay. Up till now, I've been doing quite a few, which have been purely for my private clients. So I know this month, because of travel to Zurich and so on, I've not been around to do ones for non-private clients. Okay, live now webinar. I'm putting this on the Telegram channel as well. My webinars, including the latest ones and the latest replay, you can always get from alpeshpatel.com/latest shares. Okay, so we are about to go live on various social media as well. And one of the things I want to do during this is just let me know, like I said, you got any calls, just let me know any of those issues as well that you might have on that front. Okay, so let's make sure you can see everything. And I'm going to share my screen with you. So get ready for a bit of that. You should be able now to see my screen. There we go. Please read all of that information as well, won't you? Because that's critically important as well, that you do indeed read all of that. So, having taken care of those things, let's get into this. Now, for one of the things, as well as the stocks that I like at the moment, are we overbought? Some strategies for handling those gains that people have got. One of the things that I'm keen to do at the same time is make sure that I also go through individual stocks. Now, the problem with going through individual stocks for most people is that what they don't realize is that you should actually think of them within a portfolio. When you look at individual stocks, which is great if you're making, some kind of newsletter which is trying to sell its services and get everybody all excited about how they got one thing right. The problem with that is when you don't look at it as a portfolio where one stock's rises might cancel out another one's volatile falls, but both are going up overall, you can often lead to panicking out of good companies and holding on to bad ones. So we want to look at this as portfolios as a whole, not just individual stocks, though I know everybody's always addicted to individual stocks. I get that. So we will cover all of this side of things as well. We're going to cover all the bits to do with pensions and retirements, and I'm going to answer all those questions. Now, first thing I want to do is I want to cover what's going on in the markets. Okay, so in terms of what's going on in the market, what I want to do is go through some of the biggest headlines at the moment. And obviously we've picked a good time. So the best way to do this, and the things I'm going to cover, is look, if oil stays at below $80, we don't have a problem with stocks. I can deal with oil really clearly, really quickly. Okay, oil is not an issue at the moment in terms of difficulties. If we go through some of the other stuff, the Fed reduced interest rates. The real issue is, are they going to do it again in December? Okay, now they're keeping everybody all very excited, and because they're keeping everybody all very excited, the good news is that the market will keep buoyant as a result. Okay, if the market keeps buoyant, we're all laughing. Nobody's got an issue. Sorry, just sorting out camera issues over here. Okay, and that's where we are at the moment with all of that, right? It's keeping the market buoyant, it's keeping the market excited, and as long as it keeps the market excited, we don't have a negative situation. Meta falling 13%. If you look at the statistics and the reason for that, it was more to do with a technical accounting issue, and so again, we're not too worried about what's going on over there. And if you look at buy the dip opportunities, and I'll show you some of the points with Meta, it's not really something I'm particularly concerned about either. Okay, so I just want to show some of the Meta. I want to show the Meta chart. You know, some people getting worried about it. Meta can, and it has done, drop 75% in a day. It has, in a year, as it did here in 2022. Okay, sorry, I just need to tell my team to get the hell off. Okay. An hour. What you will see with Meta, let's go back to Meta. All right, what you will see with Meta, whilst it can have these prolonged falls as it did over there, this dip here, and it does look exactly like it did earlier in the year when it dropped. It's a more volatile company. Out of Meta, Microsoft, Apple, Amazon, Alphabet, the 2 M's and the 3 A's, it is the more volatile one. And you shouldn't be surprised if you get that kind of dip. Now, if you're going to try and trade this in and out, okay, might I suggest you keep an eye on this weekly MACD, and you might wrong foot yourself, timing, trend following, it's all very difficult. And you can see exactly what happened here. And it was a 34% drop before, in actual fact, it just increased. And a lot of people would have got out right at the bottom. And so how do you avoid that scenario? Well, if you're worried, it's a sliding scale. What you can do is take some money off the table. If it drops X%, sell Y. It's not a binary decision, all or nothing. It's a mistake that private clients often make. They think everything is binary. I'm either in or I am out. It is not the case that it needs to be binary, one or the other. Okay, so what do we have with something like Meta at the moment is, depending on your risk appetite, you can say to yourself, right, you know what, if it drops 5%, 10%, 15%, 20, 25%, I will sell Y%. The mistake private clients make, private investors make, is they foolishly think they've got to be perfect and get it 100% correct as if they've got a time machine. They don't. They should be making decisions based upon their risk appetite. Got it? If you do it on your risk appetite, if it drops X%, sell Y. Stop trying to predict. You're not supposed to be listening to crappy newsletters who will say to you that they know the future. Instead, and I don't know what's going to happen with this. This may well do another 34% drop as it's done before. From its highs, when people were already counting how much money they had, it's dropped 17% so far. We know it can do this. We know it can drop 34% in no time and make a V-shaped recovery and go even higher. So if you've had bumper gains, you might say, you know what? Do what Warren Buffett does. He doesn't sell all out, which is what retail clients get completely wrong as well about the man, thinking, oh my God, he's out of Apple, he's selling the market. Retail clients tend to think in black and white, on and off. In actual fact, investing is more a sliding scale. So if you are risk loving, you would just stay in this. If you are risk averse, you would sell 100% of it. But you can write on a piece of paper, 5% drop, 10%, 15, 20, 25, 30, and write down how much of it you want to sell based upon that. Okay. Do not try and predict the future. If you want to really try and get a traffic light idea of where we are, well, look at this. It's exactly where we are. Okay. See that period there that I'm circling? Okay, it's exactly identical to this period here, and therefore, does that mean, Alpesh, we're about to get a 74% drop? Possibly. Does it mean we might get a 34% drop and then a rebound? Possibly. How do you protect without knowing what the future holds? Well, you can either say, I am more risk-loving, so I'll wait until you get the crossover here before I sell, in which case I'm risking the money I hold. Bit like poker, in order to find out the hand of the market. Or you might say, I'm more risk-averse, so I will get out, but I know I'm paying an insurance premium of getting out and having peace of mind because I might have to buy back more expensive later. Got it? Simple strategy. Works every time. Isn't perfect, but it's a hell of a lot better than gambling and guessing, which is the idiocy of what most people would do. And I'm giving you experience of not just myself, but some of the world's leading hedge fund managers I've spoken to and who have been in my books and the like. And if you want to download free copies of that, go to alpeshpatel.com/links. So let's go through some more of this. Okay, Powell's December warming, it's hardening divisions at the Fed. Are they going to reduce rates in December? The market will gradually come to terms with the fact that companies are making profits. The Fed might, if they don't do it in December, they'll do it in January. All is fine with the economy, and there's nothing to worry about, okay? Off the back of that, oil above below $80, and we're fine. If you want to hear my views on oil, I love this video on my YouTube channel. If you go to my YouTube channel, view your channel, there we go. Okay. Talking about oil, and it's always right. Basically, if you keep listening to it often enough, there it is, and it's where I'm talking who was my co-presenter on my show at Bloomberg, and what we're talking about is just basically if you keep at the levels it's at now, then you're fine. Basically below $80, and the stock market is going to be perfectly fine on that. Got it? And if you want to know where all these are, alpeshpatel.com/links. Right. So oil is not the great destabilizer. Dealt with. Done. Move on, right? The problem private investors often make is they pontificate and pontificate to another level. Somebody said they can't hear me, from Stefan from Zurich, but I think everybody else can, so that's good. I hope everybody else can. Just give me a thumbs up if you can indeed hear me. Okay, and we'll deal with some of that later. Now, is there anything else on here that's worrying me? Well, no, because the whole China issue and Trump, whilst he's exaggerating the deal, the Chinese are far cannier than Donald Trump is. It is positive for the market. What are you going to think about is, what is your focus? The focus is the market. If the focus is the market, everything else is irrelevant. And does it impact the market or not, and to what extent? And then move on. Now, Trump saying he's got some kind of a deal, that's positive sounds for the market. It is not negatively impacting it. The precise nature of that deal, whether he has or not, whether he's deluded, none of that is causing a negative impact on the market at the moment. So that being the case, it is not negative, so it's good, all right? It's not negative, therefore it is good. It's as simple as that. So out of news and all the news that we see, there is nothing that's currently negative. Now, AI, is it in a bubble? I've written an article about this. Go to campaignforamillion.com/blog. Is it in a bubble? I've taken some of the data from Goldman Sachs. And if you look at that, if you look at that data, then what you will see is we're not in a bubble yet because of the profitability of the underlying companies. And after the expectations of profits become unrealistic, in other words, we're paying so much money in order to get unrealistic profits, we still don't need to worry, because momentum takes over for a while and gives us ample time before we have to panic and exit anyway. Okay, so that gives us a lot of protections. It gives us a hell of a lot of protections on there. By the way, in case you're not aware, you can listen to my podcast on all of this on Spotify. Okay, just look for Improve Your Pension with Alpesh Patel, and you'll see it on Spotify. Okay, AI Boom or Bubble, that was recorded on Monday. We've got stable coins, we've got Collapse of the Magnificent Seven, who are the real AI winners, trade wars and inflation, and that's just been in the past month, in under a month. So in the past month, we've done about, what, 1, 2, 3, 4, 1 a week, roughly, episodes. So it's on Spotify, but I'm sure you can find it in other places, wherever you get your podcasts. Okay, for those who aren't aware of my podcast broadcasts as well. And of course, on the YouTube channel, you'll see a lot of what I'm talking about done on the videos as well. I'm everywhere. All right, I'm everywhere. Now, what I'm going to tell you is not individual advice, because I don't know individually, and it's not a solicitation to buy or sell. Incidentally, my next Financial Times book, I am still in the process of finalizing it, forecasting share prices. I am far better at forecasting share prices than I am at forecasting when the hell I'm going to deliver my book. Okay. Now, one of the things we're going to talk about in this is stocks, individual stocks, which is what everybody loves. You know, it's the glamour thing. It's the thing that gets everybody excited, but actually far more important are portfolios of stocks rather than individual stocks. How do they do as a team? Okay, investing is a team sport. It is not about an individual stock, though I know retail clients won't listen to me. And you can tell the caliber of a retail client, because the ones who will talk about, oh, well, give me a stock pick, and they start sort of rubbing their legs in frantic excitement, are the amateurs. And the more sophisticated ones will say, what's a good portfolio? Because the way Warren Buffett became the richest man in the world was with a portfolio, not stocks. Think about this. He never had a portfolio in his entire career which had the best performing stocks in the stock market in it in any given year, and where every single stock in his portfolio went up that year. Never had those two conditions ever met, and yet became the richest man in the world. Private investors, the reason they don't get wealthy is because they get it all wrong. They do the exact opposite of what they should be doing. So let's start off, first of all, with the tools. We've created some wonderful tools before we get into individual stocks. I know what you're here for. You're here for stock porn, the individual stocks. But first of all, I'm going to give you the boring stuff. The tools, campaignforamillion.com/tools. These are all free. These are all completely free. You're welcome. I pay for the cost of it and the developers and the software engineers and all the rest of it myself. Right now, what I want you to do, because I want you to be sensible, I want you to be responsible, is first of all, just have a look at the free pension calculator, your current age, your retirement age, your current savings, your monthly contributions, annual returns, inflation rate, and just work out how much you're going to have. It's going to do it all for you. It's going to do it all for you. Okay. It's going to calculate that. Now it gets better. How do you know how much you can safely withdraw? If you're young, this isn't so relevant for you, this particular tool. Okay, starting investment, expected annual growth rate. Let's say we could get that up to 15, which is the US stock market average, years of contributions, withdrawal rate, life expectancy. What's your monthly income? But of course, a volatility in the stock market means it's not guaranteed. You might have a really good tailwind of projections, or it might be worse. So it gives you your best and worst case, and your safe withdrawal rate, how much you can withdraw each year. And what I find with this, which is amazing with clients who use it, and it's completely free, I'm going to say it again, because most things in life are not free. What most people find with this, well, actually 50-50. What some people find is, oh my God, they're already closer than they realized to having saved enough, and they don't need to worry, and they might be oversaving. And then 50% say, oh, I really need to get a grip and start increasing the growth rate. If that is the critical number, the growth rate, your IFA and wealth manager will not tell you that, because those lying little cheating weasels know all they're ever going to do is collect a commission off you by shoving you into a 5% per annum fund where they get massive kickbacks, okay? And they'll say, oh, we don't get kickbacks, we're not allowed commissions anymore, it's all changed and all the rest of it. Oh, really? Okay, so I've written in depth, I've written about this in my Financial Times columns in the past, and all they've done is just change the way in which they get fed by the industry and how they are just basically ripping clients off to give them 5% per annum. Why are they giving you 5% per annum when we know the market as a whole generates significantly more than that? Don't take my word for it. We know the market does. For those who are watching this on the webinar, which is at alpeshpatel.com/latest shares. So if you're watching it on there, I'm going to share some very important files with you, which include problems with IFAs. The rest of you watching on TikTok, I'll show you where you can get these as well. And a copy of my book, a free copy of one of my 18 odd books. And, well, dropping it. Don't drop it, for God's sake, son. Okay. Now, let's go to one of the other tools on here, stress testing on safe withdrawal rates. Now, this is what catches a lot of people out. What they don't realize is as they start withdrawing their pension, if they take more money out when their pension has a down year, assuming they're investing into retirement and letting the market work its best, then if they don't run a stress test, what's called a sequence of returns calculation, it's all completely free, then they would more likely run out of money sooner. Basically, the cheat code is, and we explain all of this for free, the cheat code is in a down year, try and withdraw less. In an up year, you can withdraw more, save the good years. And we show the medium versus the lucky versus unlucky sequences. Starting off with the same amount of money, what happens if you get a bunch of bad years first compared to good years? Even if your average annual return is 15%, because you might get 0, 0, 0, and then 30, 30, 30. That still averages 15. Okay, and that makes a massive difference compared to getting 30, 30, 30, and then 0, 0, 0, because the amounts you're taking out when you got 0% really hit into your capital and you got less money to compound. It sounds obvious after I say it. The maths gets a bit messy, and so we got a calculator to work it all out for you, and it's on there. Now, that only applies to the older ones of you. It gets better. For the younger ones, we've got the FIRE tool we've created, which is Financial Independence, Retire Early. There's those of you watching on TikTok who probably want to retire yesterday. Well, guess what? That free tool, again, campaignforamillion.com/tools, power of compounding. We show you how close you are to your targets. If you're 40, I don't know, let's say you're 30 years old, your goal age is, forget that, you want to be on your beach by the time you're 50, maybe. Well, you better get that growth up to what some of the US equities have been doing. They just happen to be listed in America. I couldn't care less where they were listed. And you better start getting mummy and daddy to save, give you a bit more capital if you're in your younger age. And it'll show you're 10% of the way there to your million current progress years. Remaining projection at 50, yes, you'll do it. You'll over exceed it, if anything, if we get that growth rate. In fact, you could take a break and be growing less. Look at that. You could be growing a lot less at, say, 12% and still get there. Okay. Now, of course, there's caveats. The world could end tomorrow. They're starting nuclear testing again. Thank you, Mr. Trump and Mr. Putin. So none of this might be relevant for you. Might as well just go and blow it all today because we're not going to be around next year. I don't know. The past doesn't guarantee the future because if it did, then we'd be guaranteed that there's not going to be nuclear war. We don't have that guarantee. So where does that leave us? Well, if you look at this, it will show you how close you are to achieving your financial goals. We've even got a lifestyle calculator for you, which tells you, allows you to work out based on how much money you want to have. How much do you want to have? How much do you want to live off eventually, and how close you might be to it, and how close you are to what are the typical standards. It even tells you what the moderate, comfortable retirement in the UK is as things stand, and in the US, and how close you might be compared to other people. So you can compare yourself to other people and work out if you're keeping up with the Joneses or not. Okay, so that's all on the pension lifestyle calculator. And one final one I've got for you. We created all these free tools. You can upload a picture of yourself. Look at that. You can upload a photo of yourself, and it will tell you whether or not you are on, or how much you should have for your age saved up, and how close you are to getting that achieved or not. Like I said, campaignforamillion.com/tools is where all those free tools are, or just if you go to campaignforamillion.com, you'll find it there. And did I say it was all free? Okay, so that'll help you with all this. Now let's get on to the stocks. Let's go on to what you're all really here for. Okay, and you got to recognize pension growth is the key thing. Growth is the number. Even if you improve it by 1% per annum, by getting rid of your crappy IFA and your St. James's Place and your Aviva funds and all the ones of it, and then that's the thing which will allow you to shave off years off your retirement. Okay, it is going to be that. In order to do that, use my free calculators to work out where you are, where you need to get to. The reason most people don't do this is because there aren't free tools available which are simple and easy to use, and that's why we created them. If you want to learn more about all of this, and there's a Google Drive with all these files on it, just go to upshell.com prospect. I know there's tons and tons of information I'm throwing at you here, and there's a lot I'm telling you to look at. But seriously, it is good quality stuff, and that's why I'm telling you to do it as well. Okay, there's a bunch of files that I want to, for those who are on the webinar, I'm just going to share with them, including one on conflicts of interest that exist in the industry. The IFA has a conflict of interest in that they will not tell you when to go into cash because they earn less fees. So if there are times when you should be holding cash, they won't tell you. They also have a conflict of interest in that they can only put you in things which are in front of them. So they're often tied. And the way they hide the fees is they'll say, oh, you're going into this St. James's Place master fund. And what they don't tell you is that fund is then investing in a bunch of other funds under it. Okay. And because of that, what ends up happening is you think you're only paying 0.5%, but the funds that they're putting it in, which are their own company funds, it's called vertical integration, means that you're actually paying them a hell of a lot of fees hidden in a lower layer. Now, what's going to happen with the falls? There are two types of falls, and there are two types of actions we can all take when the market inevitably falls, because it always does. The two types of falls are long and drawn out, and the opposite is short and sharp. Okay? Now, we don't know which of those two categories is going to be. Listen to this. We've simplified this into the simplest logic that anybody could understand, and it's very easy to understand as well. Okay? You don't know if something, let's play a game. You don't know whether something's going to be long and prolonged, a long bear market like 2022, or short and sharp like February to April 2025. Now, if you don't know which one of those two it is, the only thing you can go by is your own appetite for risk, which is a question of something you might have to meditate yourself on. All I know is most people think they've got a bigger appetite than they have. So if they think out of a score of 0 to 10, they're a 7, they're usually a 5. Now, what you can do in that scenario is this, and this is the smart move, and it's to do with game theory and all the rest of it, is this. You can work out, are you risk averse or risk loving? And you can say, if you're risk loving, you may well sit through the decline and sit back. That's more a Warren Buffett approach. You will not panic. You will not get bored by the long, drawn-out fall, which takes a long time to recover. The Warren Buffett approach, okay? The man's more risk-loving, obviously. No panic, no boredom. The alternative to that, if you are more panic-prone, is that you get out, knowing you're paying an insurance premium that should it be a short, sharp recovery, you'll have to buy back more expensive. But if it's a long, drawn-out fall, you'll be relieved and not have an ulcer. In between those two extremes, you might do 50-50, for instance. So now you've got three options. Either stay all in, get all out, or 50-50, right? Only in hindsight will we know which of those three answers is correct. Hindsight is irrelevant in that regard. What is relevant is the only thing you actually know in foresight, okay, which is your risk appetite. So think about that, right? And like I said, most people are more prone to panic than they realize. And it is normal to have large down days. That is the point at which most people will panic. Look at that data. Total number of 1% down days in the S&P. That's in 2025. We've been below average. We are due, statistically, more panic, more deeper falls. There is no two ways about it. We are due that, okay? Zed's trying to be funny. You're funny, Zed. I think you should be able to tell from what I've said that you're not as funny and smart as you think you are. Oops, gone. Now, the problem is, and by the way, if you want to outperform the S&P, it's really simple. Just do 2 times leverage S&P 500. It goes up more often than it falls. There you go. Simple. Any idiot can outperform the S&P 500. 2 times leverage ETF, exchange traded fund in the S&P 500, which I'll show you in a second. The problem with it is most people will panic when it falls. People like Zed will panic and wet the bed a bit when it falls. That's the problem. If you are going to be worried about those falls, then that is a reason to have less money in the market. And you can scroll back on how much you put in the market by working out what's right for you. There's no point you putting 10 million in the market if you're going to absolutely panic and throw up. Okay. As well. Patel.com prospect not found. Oops. Let me just do that. Apologies. Let me sort that out right now while we're on here. The prospect one, not sure why it wasn't found. I'll get that sorted right now. Alpesh.com/prospect. Whilst you go through it, this is the other mistake most people make. If you're looking at what do I take profits on, if it drops X%, sell Y is as good an answer as anything when you have an uncertain future and you can't see the future. The mistake most private investors make is they try to look into the future and they simply can't see what's happening in the future. Okay, so what you are, sorry, it's prospects. There's supposed to be a S at the end, but don't worry about that. I'm going to change that anyway so that they both work. It's alpesh.com/prospects, not prospect, on there. And what I would say is either get rid of your losers if you really want to, crop all equally, or work it out stock by stock. If it drops X, sell Y. Now, a lot of this depends on your appetite for bureaucracy, because it is bureaucratic. And you might say, well, you know what? I'll just keep it simple. I'll just hold on. Now, there's a worry about, well, why are you just talking about the US? I don't just talk about the US. I happen to look at lots of markets. It just so happens that very often there might be American ones in there. Now, that's just because when you go through our approved list, and I'm going to just show it in a second. When I go through, say, whoops, let me just look at the non-filtered version. There we go. Now, none of these meet our criteria. The ones that meet our criteria, which are green across these first five columns, if they happen to be American companies, what can I do? None of these meet our criteria. If they happen to be American, not London Stock Exchange, as you can see there, that's not my fault. What can I do if that is the case? Okay, so what I would say to that is it's not that I'm biased towards America. It's just that there's more companies to choose from. That's the reason. All right, that's the reason. Okay, alpesh.com/prospect or prospect should both work. Okay, they should both work. I'll put that in there. Pacts. There you go. They should both work, I hope. And you should be able to see the Google Drive of lots of useful data and files and things such as that. Now, why do we have such stringent criteria? Why do we look at 10,000 companies? And I'm going to mention some of the ones that I own shortly. The reason we look at all of this 10,000, this is the point at which I'll only say this once because it annoys people. Some of my clients panic. This is not the filtered list. So I don't want the clients to panic thinking, oh my God, you've shared the Holy Grail. This shows you all the ones that don't meet our criteria. It's my money. It's my son's inheritance. That's why I want to be stringent. And they have to be green across the board. If they're not green, they're not good enough. And so we then click that to filter it. And that's critically important because if you're not willing to then filter across, then how do you know you've got the best of the best? The worst thing that you can do is go to some stupid newsletter, Motley Fool, God forbid, with their breathless headlines of, 5 stocks you must own now, they're critically going to go up. Do you think for a second any of their idiotic journalists, for a second, do a deep dive of looking through all of this and have then analyzed it across the board? Or do you think they're just picking random companies because they've got a word count to meet and they're paid by the word? Okay, which do you think it is? And they've got to sell you a subscription, so they better keep coming up with names every single week, even if there's nothing good out there. Come on, wake up. And then, of course, they can market on the basis that, oh, we had one good one once. Okay, it's a marketing gimmick that they will time and again use. So I'm going to put that to one side. It just so happens, yes, the American markets have outperformed. It's not my fault that they do it. I wish they didn't. Okay. As well. So it's just like that. And I don't care which country those companies come from. What I do know is I want to make a return. That is the point. This is from Goldman Sachs investment research. It's about, are we in an AI bubble, which is what people are talking about. Now I'm going to dismiss that straight away. There's profits in the companies that we're in because the nature by which we select them, they have to be profitable and growing. And therefore, certainly the companies we're in will be more resilient to falls. There will be falls. It's inevitable. There will be falls. Okay. But there we go. There isn't, say, Goldman Sachs, even if you don't believe them. I've put it into a podcast, which, as I told you, my podcast is on Spotify, and you can listen to it there. And I've also put it into an article on campaignforamillion.com blog. Why so much stuff in so many places? Well, some of it is suitable to videos. Some of it is suitable, are we in a bubble, okay, to written articles and deep analysis. All right, campaignforamillion.com/blog. Right, that's the bit about AI and where we are on that. And you know, it's difficult to explain this. We've got the Spotify thing anyway, but I then go into it, and then I've gone into the individual companies that Goldman Sachs have broken down to look at valuations, etc. Valuations are stressed, but not yet consistent with historical bubbles. And so the details of the Goldman Sachs report, including the names that they happen to give. Now, somebody might say, why are you giving the names away? Why are you giving the names away? I'm not. Goldman Sachs broke down some of the names. And I do, as some of you have been following me, and if you watch this, you know I own some of these. Okay, not all of them, but I own some of them as well. So they've analyzed previous bubbles and what market weighting looks like, market capitalization, forward price to earnings ratios and the like. That's all on campaignforamillion.com. It's all free, campaignforamillion.com/blog. Why do I go into this detail? Why do I look at the data from, say, a Goldman Sachs and the stock market before I say we're in a bubble or not? Well, because it's of my academic training. Okay, we're going to look at the data. We're also going to look at what the smart money is telling its wealthiest clients, because they're the ones, if they start telling them to evacuate, then it's almost certainly going to happen. So if you want to look at the detail, that's the level of detail I go into. All right. So you can see why it can't all be done in a webinar. Like I said, it's all free, campaignforamillion.com/blog. Are we in a bubble? All right. And there's a whole bunch of other stuff where we've also gone into bad fund managers and why diversification isn't what you think it is. This is the other problem. People go, well, why are you not diversified across countries or industries? Because they read about something from the 1950s when the last set of textbooks they looked at came about. And then we look at the data and we show them that actually correlations have increased in an interconnected world. Otherwise, Donald Trump would not be going to meet President Xi in China if correlations weren't interconnected. And therefore, we then look at, well, what does that mean for diversification and how do you do it? And is it even possible? Okay, is it even possible to do? So all of that, campaignforamillion.com/blog, and it's all free. So bottom line, no, we're not in a bubble yet. Though I'm going to show you where we are on things. Top 10 US companies that dominate the world market. Okay, so they pay me the big bucks to pick things that you've all heard of. What can I say? This again from Goldman Sachs. The top 10 US companies are worth more. Their market capitalization is more than the GDP of China. 10 American companies have a market capitalization more than the GDP of China. Okay, more than China. Can you believe it? That's just the size and scale. So if they bubble up when we filter by valuation, growth, income, cash flow on our filters, if they bubble up to the top and yet they're obvious names, what can I say? They are obvious names and they've bubbled up to the top and they made the cut. Sometimes life is just flipping easy. It is not that you're looking for some esoteric nuclear fusion reactor company out of Wales or New Zealand or somewhere. It is sometimes you're just looking for a bloody household name. What can I say? Sometimes it's easy. It was easy in 2023 and 2024. And it doesn't have to be one of these. None of these meet the criteria. Okay. So that's the point of it. And if it's easy, it's easy. And at the moment, it's been pretty bloody easy for a few years, more than I expected, right? When I was doing my Bloomberg show 25 odd years ago and we were going through the dot-com bubble, we knew those companies weren't profitable. And at some point, they've got to fall off the cliff because they're not profitable. They were running purely on momentum. At the moment, they're running on profits. They'll eventually start running on momentum because that's the final stage before a collapse. But at the moment, the momentum is in their bloody profitability. They keep making more and more money. Okay, as long as they do that, it's fine. This is the best way to predict a market top. This got me worried. Getty Images are selling pictures of myself and my wife for £270, £375. That isn't me. Credit Tim Whitby. This is not, Alpesh's new OnlyFans account. That's probably, if anything, a sign of a market top. So those have got 4 trillion. Nvidia is at 5 trillion. And people say, well, what does that mean? Does that mean it's overbought? Have we got a bubble? Well, as long as they've got profits and the world cares about profits and money keeps paying for goods and services, no, we don't need to worry today. We don't need to worry today. So let's look at when we might want to worry. Let me draw an image to explain to you when we might want to and need to worry. Okay. Right now, here we go. That's where we are at the moment. This is just average prices, weekly and monthly average prices. Okay. And what that means is that either we are, one of 3 things is going to happen. Get ready for this. And I want you to write this down, the date in your diary, 30th of October, Alpesh said it. Right. One of 3 things is going to happen. 1, we are going to get a short, sharp V shape as we did here. So it's going to be one of these. Right. What probability would I put on that? I don't know. 10%, 20%. I don't know. I don't care. Okay. It's going to be like that. Or 2, it's only going to be one of 3 things. Get ready. Right. 2, it's going to be like 2022, which means we go like this. Now, everyone's got an opinion. Retail clients are the most over-opinionated, under-factualized individuals you'll ever meet. There's professors at Oxford who would have fewer opinions than a retail client. There's professors at Oxford with more data and information who will have fewer opinions than retail clients with no data will be mouthing off what they think is going to happen. It's amazing. Unsolicited. Nobody even bloody asked them their opinions, but they'll be happy to give it to you. So one of three things is going to happen, and I don't know which. I don't have an opinion on it. So I'm going to tell you how I position myself on it. So number two is going to be this. It's more prolonged, right? There. Now, I'm sure lots of people want to give their opinions. Feel free. I've got a delete button as good as anybody else. Now, that's the second thing that could happen. And it will look like this. 2022. Those happen relatively infrequently. Those we call daddy bears, okay? This we call a mama bear, right? They happen more frequently. So these happen once every 7 years. These happen once every about 2 to 3 years, okay? Now, the third thing that happens, which are less probable, is this just keeps going up and up and up, up. Okay, and it's less probable. It happens about maybe 1 in 4 times when you're this overbought. By overbought, I mean, if you look at this graph, you're in the top quarter. The average prices, short and medium term average prices, just keep going up. Okay, that's unusual because usually what happens is when prices have extended, somebody wants to take profits, somebody else anticipates somebody's going to take profits, human nature to want money in your bank account. So they start selling and you get this profit taking. For it to keep extending in a competitive marketplace where people are not colluding and saying, let's just keep bidding it up, is unusual. And that happens maybe 20% of the time, 25% of the time, infrequently, in other words. So those are your three options. Now you might as well, it's bloody useless. No, it's not useless because what it tells me is today, right, I've only got 3 decisions to make. Do I buy more? Do I hold? Or do I sell? Well, I've got no reason to sell. I've certainly got every reason to hold today. Would I buy more? I would buy more cautiously, knowing that that is a bit overbought and I might be buying at a peak. And if I'm risk loving, I'd do that. If I'm risk averse, I obviously wouldn't. Do you see how that decision-making process was made? What's the decision I need to make today? How do I divide that up into 1, 2, or 3 categories? Okay, and then how do I work that out based on my risk appetite? What's the right one for me? And whether it's binary, I buy or I don't, or a sliding scale. Simple. That's how decisions should be made. Mental clarity. And that, when you don't have a time machine to go into the future, is a more sensible way to do it. So that's the S&P and my view on it right now. For those thinking I'm about to say to them, I popped into my time machine and I tell you what's going to happen, which I know sounds sexy. And when I'm on the BBC talking about these things, I know that's how we tend to do it. But I'm telling you that is not the way. Trying to predict the future is not the way you want to be doing things unless you're there to speculate and gamble. I'm not there to speculate and gamble. I'm there to make a decision, which most of the time involves me doing absolutely bloody nothing. It is the best profession in the world is investing, and Warren Buffett will tell you this because you spend most of your time doing absolutely bloody nothing. I guarantee you none of you have had a job as easy as an investor has, which is to do, my job is to do absolutely bloody nothing 99% of the time. Your job, I guarantee you, will not be that. Okay, it is the only profession in the world you get away with it. And I can't believe why Warren Buffett is so loved, because you'd think somebody who goes around basically with a job where they're not doing anything would be really hated and being so rich, but he's beloved. Okay. And he should be. He should be. Now, here are the earnings that have been coming out this week. As you can see, that is what's going to move the market. That is what's going to move the market. Okay. And it's not the only ones. Today, Thursday, you've got a bunch. Friday, you've got another bunch. Look at this. You got Apple tomorrow after market close. There's your Friday night buggered up. Talk about Halloween bloody party. So we've got Apple coming out. Now, I think Apple are probably going to blow the doors off. But am I going to sell my Apple holdings beforehand? No. Would I buy more beforehand? Well, I probably don't have a problem. If it falls afterwards, I'd probably buy even more. The kinds of stocks you want, you've got 2 types of stocks you can own. There are only 2 types you can own for whatever risk appetite you've got. And listen to this carefully. They're the type which when they fall 20%, you're throwing up and you wish you'd never bought the bloody things and you need to get out of them quickly. And they're the type when they drop 20%, you think to yourself, brilliant. I love this company for all the fundamental reasons. It's going to go back up to all-time highs. I want to buy more. My portfolios are of the type where I want to buy more. I am not in the business of speculating and gambling where I think, shit, it's fallen. I will wish I had less. Okay. Now I can do that. It's called trading. Okay, but that's not what this lecture is about. Trading is not what this is about. This is about investing. Okay, so Apple's in that category, for instance. Okay, my train technology is in that category of, well, if it falls, I'll buy more. And I've got the data to back it up. That's the important thing. I've got the bloody data from the undervaluation, the revenue growth, the dividend yields, the cash return on capital invested from Goldman Sachs Wealth Management, the momentum from the hedge fund industry, and critically importantly, Sortino, average return versus downside volatility. So I know at any given moment, thanks to a very clever data analytics team, what's the probability if this has a down month of more than 5%, that it's likely to have an up month next month, and therefore I should buy into it. And they'll tell me there's a 75% probability that if you buy into this next month, it's going to be up at least 5%, and therefore you might even want to leverage the hell out of it. That's getting more into the trading side of things, but we can get that data. We look at it and we go, right, bang, those are the kinds of companies I want in my portfolio. And guess what happens when you've got those? You have no reason to panic. You've got no reason to get bored. You sit on your ass all day long and you do nothing. Because that's the obvious thing too. What do retail clients do? They love to look at CNBC and get panicked and worried because that's what CNBC wants them to do. Breathless headlines. Let's look at some of their breathless headlines. The biggest takeaways from what Truth covers and what's still unclear. Whole rate stays going shows resilience. AI bubble fundamentals real. What to watch for as stocks soar. Well, there's a breathless headline. Okay. Shark Tank event. How entrepreneurs? Maybe not so much. They'll have something. It's usually around Kramer. By the way, of these biggest movers, I don't own any of these, and that's fine. You can still make a lot of money by not owning any of these. I don't own any of these, and that's fine as well. Okay, it is slow and steady, and as Buffett showed, you end up making a lot by just being the tortoise, not trying to be the hare. I know it's fun trying to be the hare. Okay, earnings coming out as well. So there's a lot, and then you've got this on Friday. Okay, you've got still a hell of a lot coming out. Then you got Monday. Okay, and you've got some really important ones coming out then as well. Okay, just trying to keep an eye and see which other ones. Bloody hell, you got next year. We're in earnings seasons. Americans have this 4 times a year. Okay, and that's where we are with earnings season as well. So how's the past week been? My God, I've spoken so much on all of this. Look at the past week. I'm not bothered. Let me be absolutely clear with you. If you want to gamble and trade, which is what all the stockbrokers want you to do, all the spread betting companies and CFD companies, they love to shove you with information and cause you panic so they can sell you newsletters. I don't care what's happened in the past week. If I've got good companies, what the hell do I care? What do I care? Okay, yeah, that went up 10%. Well, I'm not gambling on it. If I wanted to do 100 times leverage, 10% rise gives me 1,000% return in a week. I haven't got the kahunas to want to be doing that. Okay, what about the past year? That's more like it. I want to look at the past year. Look at that. That was pretty disappointing. For a company which has made so much profits, and those profits moving from the P&L to the balance sheet, and therefore the price, the share price to the book value, because the book value sits in the balance sheet, whereas the price to earnings ratio sits in the P&L, the price to book value, which is the more conservative measure of valuation and the one Warren Buffett prefers, means if that's only gone up 16%, its price, and it's earned so much profit, its price to book value must be really cheaper than it was a year ago. And that's why Warren Buffett owns the bloody company, or 30% of his money's in Apple. And yeah, cheap. Oh, I've got the new one. There you go. And they've made some breakthroughs. I don't try and predict what Apple's going to do. That's not my job. The way you treat these companies is, imagine you bought Apple or Amazon or Broadcom. That's Broadcom. Okay. Imagine you bought these and you go to Cupertino. And I've stayed in Cupertino, and I tell you what, it's full of my fellow Indians. They seem to run Apple. Anyway, you go to Cupertino and you go to the car park, tiny little car park opposite the Apple showroom and all the rest of it. And you say, right, we've got a board meeting. I've bought some Apple shares. Pretend you own the whole company. Now, when you're sitting around that board table, are you going to go, yeah, I've got some ideas. I think you guys have lost the plot. I think you should do this. You should do that. Well, if they really wanted your advice, they would have bloody hired you, wouldn't they, mate? Okay, you wouldn't have to buy their shares to get some action. They would have said, "Oh, we'll better find Joe Smith, haven't we? We better get our hands on old Jacob or Jazz or Graham or let me give some other people shout outs. So we got Will and so on and so forth. They're not going to do that. They're not going to do that. So keep your mouth shut. You bought that, as Steve Jobs, the man himself, said. You don't buy a dog and then bark yourself. So either buy the company because you want them to get on with the job and they'll work out the problems. But this is where the over-opinionated retail client comes in. They buy a stock and think they know they can run the whole bloody world. Sorry, it's incredible. And if you want to know how over-opinionated retail clients are, just look at X, TikTok, Instagram. Everybody's got a freaking opinion. It's a lot more sensible. Keep your mouth shut and just look at the data and say, yeah, I'm all right. I'm not in Lam Research at the moment. I'm going to show you something interesting. See that NVIDIA, which is up 43% in the last year. My Goldman Sachs holding is up 51%. It's up more than my NVIDIA holding. Now, what does that tell you? Well, it tells you that I would never have guessed that. A year ago, if you said to me, you put a gun to your head, you got to pick one stock over the other, NVIDIA or Goldman Sachs, I would have said, well, NVIDIA, obviously. But the reason I had both of those is because I don't know which one. That's why you have portfolios, not individual stocks. Newsletters like to sell you individual stocks and sexy stories and narratives. Okay, but in actual fact, what they should be saying to you is, let's look at a portfolio. That'd be respectable. That would be bloody sensible. Okay, they don't do that because newsletters are in the business of selling you subscriptions from journalists. What's your day job then? You who's telling people to do all these, I'm a journalist, I'll do this full time. Journaling. Okay, does that really sound like something which is sensible? Of course not. Of course not. Now, for those who are on the webinar, on alpeshpatel.com/latest shares, as opposed to those on TikTok, I am going to send you a document on assessing market bubble risk in 2025 as well. It's a presentation that I've done. So if you're on alpeshpatel.com/latest shares, and those on TikTok can go on there as well, then I can send that file to you. I can't send files on TikTok. I don't think I can, that I'm aware of. No. Okay. So add new file. Oops. Hopefully that will work. Oh, no. Hopefully, oh no, here we go, funds, share. Okay, so that's there. Now, let's look at the markets over the past year. So you're up 27% on NASDAQ. Of course I look clever. That wasn't me who did it. I look clever because we had a tailwind and I knew not to panic or get bored. Now, when I exited belatedly in, I think it was around March time, and got back in around May time, I ended up having to pay an insurance premium of exiting. Why did I pay the insurance premium? Well, because the market didn't fall, so I couldn't buy back cheaper. Instead, what happened is I had a peace of mind for a few months, and then when it came back up, I ended up paying a little bit more to buy back into the market. That insurance premium against the house burning down, I was happy to pay. My house didn't burn down. My real house didn't burn down this year. Do I therefore think my insurance premium was a waste of money? No, of course not. It gave me peace of mind. And it's the same thing with the markets. Either you're going to be the kind of person who says, well, I will sit through an insurance premium, I'll exit, or somewhere in between, and I'll get back more expensive, and that's fine. If you're the kind of numpty who thinks you're going to pick the market bottoms and tops, then please move away from computer systems generally, okay, and go back to crayons and paper, because you're not safe with money, right? If you think you're going to get tops and bottoms, and if you listen to people who say they can get tops and bottoms, right, then you're going to get scammed of your entire life fortune sooner or later. So the market's had a wonderful tailwind. Will it continue? I don't know. You would have thought Donald Trump was going to destroy the tailwind, but he hasn't managed to do it yet, although I'm sure he's still working on it. Now, of the past week, what's happened over the last 7 days of the year, that has been extraordinary for anybody's pension. Obviously, let's look at some of that, and if I get a bad year next year and I have to hold cash like in 2022, it's fine. This year made up for it. But spend all my profits before they've, first of all, hit the bank account, and certainly not before I know a few years down the line that they're there to keep. What if next year there are none? And all of a sudden we've got lifestyle expenses, and we counted all these profits thinking the next year is going to be like last year. No, it's not. Maybe next year is going to be 0% return. So don't overspend. The wealth effect and the psychological aspects of that on private investors, again, I've written about in my books, and you can download free copies. It's really disturbing. The work by Richard, the economist who won the Nobel Prize in economics, Richard Thaler, Daniel Kahneman, in this area is fascinating. But private investors, again, end up overspending because they think that, oh, it'll just keep happening. That's the UK. I'll do a separate one on the UK as a whole. If the 100 largest or 350 largest UK companies don't make it into my global database of 10,000 stocks, it's not the fault that they're British, it's just that they didn't make the cut. Just as if I was running a university and some of you couldn't get in, it isn't because you're from China or India or America or Britain, it's that you didn't make the bloody cut. Sorry, okay? I wasn't being racist with my stock picks, is the point with it all. Now, where are we on here? This is where we are on the NASDAQ. How do you like them apples with the NASDAQ? Can you just let me know, those of you who happen to be on TikTok, okay, that you can just see and hear everything loud and clear? That'd be good as well, okay? And I'm just going to look at the chats on the webinar as well. Now, that's where we are. It's very similar to the S&P. Now, let me tell you what's going to happen, right? I'm going to give you some definitions, which I've given in my books before, right? There are three types of falling prices: baby bear, mummy bear, and daddy bear, okay? A baby bear is where the price falls, but the average prices, as shown by the MACD, keeps rising. That's a baby bear. They happen 3 or 4 times a year, maybe 4 to 5 times a year, and you can ignore the baby crying. Baby bears, however, sometimes can become mama bears. What are mama bears? Mama bears are where, I'm trying to give a better example. There we go. That's a mama bear. Mama bear is where the price falls, obviously bear, and so does the MACD. And again, you can ignore them. They happen maybe once a year. Daddy bears happen about once every 7 years, which is where the price falls and it falls below its own moving average. That's the daddy bear. Now, here's a problem. How do you know a baby isn't going to become a mummy, isn't going to become a daddy? You don't. So if you are risk loving, and you got to decide this bit out, you might wait for the daddy before you exit. If you are risk averse, you might exit at a mama, and anything in between on a sliding scale, you'll just make a decision. Simple. Write it down on a piece of paper, put it on your desk. That's it. Is it baby, mummy, daddy? Which am I? And therefore, based on which one it is, you will take your action. Job done, go away, finished. Okay, it's that bloody easy. Now, this is one of my favorite books. Get the audio book. Nobody reads books anymore. Jim Simons sadly passed away last year. Jim Simons is probably the most successful fund manager of all time. Okay? Now, don't listen to me. Listen to him. Okay? Listen to him. He said, we don't have opinions on stocks. The computer has opinions. We follow the computer. And I'm exactly the bloody same. Not because he said so. I am the same because I tell you what happens if I have an opinion on stocks compared to the computer. If I have an opinion on stocks, it'll be beyond bloody meat because I'm a freaking vegan and it drops 99%. It'll be Bumble because the CEO looks like she knows what she's talking about and the company falls out of bloody bed. Okay. It'll be Fisker Automotive because my friend started the company and it goes into liquidation. It'll be CMC Markets because my friend Peter Cruddas is behind it and the frickin' thing drops 60% and is still not back to where it was. So I don't have opinions on stocks. The computer does. And if I followed the computer, I'd never have got those companies. But then again, if I followed the computer, I wouldn't lend money to friends or family either, would I? Okay, knowing full well I'll never see it again. Okay, computer says, that's actually a really good phrase. The computer says, no, is what I should have been doing. Now, why do I do those other things? Well, there's the same reason I might go to Vegas and put $20 on black. did it for fun or because, loyalty to a friend and all the rest of it, and I shouldn't have. But incidentally, I've never done anything for a friend where I've actually had a positive payback. Got to get a better class of friends. Now, FTSE 100, where are we? All-time high. Now, let's have a go at this, okay? That is unusual for it to break above it. Okay, and it's doing it. Now, this might presage what's going to happen on the US markets, because here, what's happened is, whereas we thought it will drop off, it's just kept rising. By the way, in the case of the UK, given all the economic woes and all the negativity, this has got more to do with currency movements and how companies in the FTSE 100 earn profits in US dollars because they largely export to America, and how that's booked into their accounts than it has to do with UK domestic growth. If you think the FTSE 100 means you're investing in British companies, I'm afraid the most British thing about them is not their ownership. It's not where they make their profits, because both of those are foreign owned and foreign made. It is simply that they happen to have a listing in the London Stock Exchange. That's the most domestic thing about them. Okay. So anyway, that's FTSE 100. Unusually for the FTSE 100, and here's a warning to you, as recently as April here, it was at 1999 levels. Okay, it has a tendency to not perform well. So this is very unusual that suddenly it's going against the grain, and I'm sure it will revert back to mean. The S&P 500, which I happen to own this, I don't recommend this. This is not a recommendation. It would be incredibly irresponsible for me to recommend anything leverage, let alone give any kind of individual information. But that's where we are. Now, is that going to pull back? In which case, people are going to lose 50% of their money in 2 months. Now, I want to tell you something. What is what I call a pain index, or an ulcer index? An ulcer index for any security, whether an exchange-traded fund or otherwise, is depth of fall multiplied by duration. Okay? Depth times duration. Now, that's not a sophisticated measure. You measure the depth of fall, say 20%, times duration, say 11 months, and that comes to 220 pain. And you say to yourself, shit, that's a lot of pain. That's too much for me. Okay? And you look at it and you say, no, depth, duration, not for me. Depth, duration, not for you. Okay? A very easy way out of it is anytime it's a mummy bear, you'll get the hell out of there. All right? And you'll only enter if it's rising. And if that falls, you get the hell out of there. Okay? That will make you incredibly rich. You'll outperform the S&P. And you'll say to me, can you outperform the S&P? And I'll go, yeah, there you go. Bang. Simple. All right? There you go. Simple strategy. Strategies are not the scarce resource. Money, capital is the scarce resource. Okay? Now, the ulcer index, depth times duration. Be careful. This has an incredibly high ulcer index. It is not suitable for people other than those on a risk profile level of about 10 out of 10 risk loving. Got it? So when you see these things, be cautious, be careful. Okay? Be very, very, very careful. Okay, when you see these things. Like I said, easy strategy, monthly MACD rising, you're in, falling, you're out. And that'll keep you busy for the next 5 years. You'll make shed loads of money and you'll thank me and you'll go, bloody hell, that was a lot easier than I thought. Yeah. And you can even test it yourself historically. Why don't most people do it? Retail clients don't like doing things which are simple. Whilst I still continue to hold this, I do not recommend this for other people. Why? Well, look at the depth of fall. Just look at that. You're going from 2,000 to 1,000. That's a 50% drop. Now, why would somebody like me get out of that? Or when? Well, they'd get out there and they'd probably start getting out there. But for the moment, whilst that's rising, i.e. average prices are rising, I'm happy to stay in. Why? Well, because I've been doing it for 25 odd years and it seems to work most of the time, and enough that I've got enough evidence that it's okay for me. Most people will panic, okay? Or they'll just get it wrong, even though it's a simple rule. So the reason I'm showing you that is what I own. Now, Apple is like so many of these. Okay, by the way, this website is TrendSpider. You've also got TradingView, you've got Yahoo Finance, you've got Google Finance, all right? So you can take your time looking at these things. A lot of these companies at the moment are looking rather like they did during these periods. In other words, do not be surprised for these kinds of falls. They're due, they're going to happen, right? If you want to try and trade in and out of those, you're going to lose money. If you want to trade in and out of those, you're going to lose money. This is a return histogram of Apple. It can drop more than 10% in a day. The probability is low. When something has a very low probability of a big fall, we are more likely to panic than if it has a high probability of happening. If something has a high probability of happening, which is the probability of it raining in October in the UK, high probability of that happening, you're not about to panic, are you? Oh shit, it's raining. But if something has a very low probability, like snowstorms in July in the UK, you might start thinking, oh my God, it's the end of the earth. Okay, so low probability, which this has, of a big fall would cause panic. The thing about certain stocks, and these are the types you always want in your portfolio, are the ones which look like this. You might say, well, no, aren't there anywhere there's no falls? No, I'm sorry, there aren't. Grow up, okay? But if you can keep those numbers below, well, you can keep in these numbers, you're doing all right. What this also does is it prevents panic. Why? Because if you've seen what can happen, you're less likely to panic. Panic is also caused by the unknown. Ignorance causes panic. Okay? In the old days, you saw a comet and you thought it was the end of the earth because you were ignorant about celestial movements of bodies. Right? It's as simple as that. So, what do we have in front of us? What we have in front of us is what you want, a positive skew over a longer duration of a greater and a positive return, but short term might cause panic. Now, you could create a trading strategy if you wanted. We're not here to trade, we're here to invest. What that basically is telling you on the screen is do not panic, do not get bored. But there are very few companies like that. That's why we have to look through 10,000. And can that take you from a 7% annual return to 15 to 40? Well, last 2 years, the market has been doing so bloody well that, yeah, you get a tailwind, you make ridiculous sums. Will that continue? I have no guarantee at all. The market might never rise ever again after tonight. Who knows? Now, Alphabet, very similar. Look, similar kind of story. But if you are not prepared for this, and you're going to try and trade it, you're more likely to get wrong-footed. That's Alphabet's return distribution. So I know not to panic if after 20 days it's down 18%. In fact, guess what? I know what to do. Yup, you guessed it. Put it in the comments box to buy it. And my God, if it's down after 50 days, 28%, I am doing a rain dance. Why? Because I'm knowing if something's down 28%, that means it's going to rise to get back to where it was, 35%. If that's going to go up 35%, I've just locked in a 35% rise in my pension. Thank you. Please fall. Please fall 28%. Because guess what? When it falls 28%, goes back to where it was, I make back anything that I might have lost on paper, plus I get to buy in and make the extra gain as well. And when I do that on double leverage, even easier. But forget leverage for a second. Those kind of return histograms, there's under 10 companies out of 10,000. I wish I could invent them. If I could, I would. Right? So I'm more than happy with those. Okay. NVIDIA. Let's look at this because it's popular. That's 2022. Now, in 2022, we had to hold cash because virtually every single stock was looking like this. Okay. It looked like, I wasn't guaranteed, a prolonged fall. In fact, it looked like it earlier this year. And I ended up exiting NVIDIA at the daddy bear stage only to buy back more expensive later. So I ended up exiting around there-ish and having to buy back a bit more expensive. It was an insurance policy I had to pay. So be it. But it avoided me having this period and the uncertainty that I might be locked in to that kind of a fall. You might say, well, in hindsight, it was obvious it was always going to rise. Well done, you. You're better the person than I am. Easily done. Others would say, no, I'm always going to just keep doubling down. So what I'm saying is there's alternative approaches based upon your own appetite. You don't have to stick to one type of view. Got it? By the way, as we go into this, I'm also on LinkedIn. You can find me on LinkedIn. That's what I look like. And I post articles on there as well. So I did quite a few freebie ones on there, sometimes about politics. That's me. There I am. but sometimes just about how we're trying to change asset management, wealth management in the UK, which was this one. What we're trying to do is get rid of commissions because it creates a conflict of interest where the IFA is just constantly charging you for bullshit returns and no growth. Whereas if they just told you to go in an index tracker, you'd be better off. So if you go onto my LinkedIn, you'll find it, sometimes political, as I said, but usually not, sometimes to do with work and productivity, and then some of our tools on there as well. Okay, including why we do better than traditional asset management. Don't charge bloody fees for commissions and fees for a start, but it sort of explains all of that, and then you'll get all this data. So that's all on LinkedIn. That's my dad from back in the day. He floated a company on the Mumbai Stock Exchange. I guess that's what's got me on the stock market, and it's still there and profitable as well. So, NVIDIA. Okay, now, the issue is, do I need to buy, hold, or sell? Well, I could buy more, as I did yesterday, but I'm well aware that I might be buying at the peak and it could drop. Would I hold? Yeah, because I've got no reason to sell. Would I sell? No, I've got no reason to sell. What's the earliest I might think about selling? Well, possibly a mama bear, but not me. Daddy bear? Possibly if I'm willing to pay the insurance premium, but I'll make that decision when I need to make that decision. If you start making that decision too early, you're not going to spend any time smelling the bloody roses. That's where NVIDIA's one looks at. Now, if NVIDIA drops 28% in 20 days, please God, let that happen. Even better, let it drop 40% in 50 days or 42%. Let it go half down. If its valuation halves, I am filling my boots because I'm going to double my money. In fact, with the leverage, I'll triple my money. Okay. When it went to $100, I said to when they had a stock split and it went to $100, I said to my students last June, this is going to double. And some of them did 2 times leverage on it and they tripled. One of them emailed me recently. Now, that sounds sexy, but it's not about individual stocks. It's about portfolios. If it was about individual stocks, I would have put all my money in NVIDIA. I wish I had, and then would have made lots more money. But I had to spread it across different stocks. I'm not in Novo Nordisk. Why? Because we don't do bottom fishing. I will eventually get in when that bottoms out and starts rising. Okay? It's ridiculously cheap, but not at the moment. Not at the moment. I don't care what the analysts say. Not at the moment. Got it? You got to be willing and able to sit aside. Now, Novo is not the type where I'm going to buy more of as it falls. Why? Well, because look at those numbers. They don't suit it. Got it? Like I said, LinkedIn as well. Don't forget, there's still more to come. Campaignforamillion.com. I want to change the face of asset management. At the moment, what happens is you give your money to an IFA, wealth manager, fund manager. They put it into a load of shitty funds, give you 5% growth. I want you to keep hold of your money and not pay any monthly, weekly, or annual fees. I want you instead to get all the data and be able to manage your own money in a SIP, pension, or investment account and have all the data, and we give you the data and we do all the hard work. But we don't have a conflict of interest with you because you keep hold of yours with whichever broker you use, Barclays, Hargreaves Lansdown, Free Trade, whoever. And we give you all the data so you can understand, as we put it, cognition, i.e. brains, over commission. Don't charge commissions and fees and subscription fees. Whatever you do, you must make sure any company you have ticks the valuation box, the growth box, and the income. You want companies here in the middle. Don't ever buy into a fund, which is a value fund or a growth fund or an income fund, because what they are or don't ever buy into a geographically restricted fund, because what they're actually saying to you is we're going to pick from a very narrow gene pool. Okay, we're going to pick from a very narrow gene pool. Don't do that. And I'm going to tell you what happens if you don't listen to what I say, because my secretary worked for me for 2 years, went into the retail side of things, didn't follow what I showed, and has ended up getting really bad performance as a result. And I'll show you that in a second. Okay. And I'll show you a real life example of what happens if you don't bloody follow what I say. Make sure you have the high standards. It has to be undervalued, has to be growing, has to be producing dividend yields, has to show momentum, i.e. positive returns. And if you're going to pick anything statistically, please pick Sortino's. Okay, high average return versus low downside risk. Now, I've told you about mummy, baby, and daddy bears. Okay, 1 is a daddy bear, 2 is a mummy bear, 3 is a baby bear. Baby bears can be ignored. Mummy bears, if you're risk averse, you can start taking some money off the table. Daddy Bear, you may well take all of it unless you're very risk loving, in which case you'll sit through it. If you're risk averse slightly, you might, as I am, I'm slightly more risk averse than most people, because my job at my age is not to F it up. Okay, as Michael Bloomberg famously once said when he became mayor of New York, he said his job is not to F it up. Now, this was a previous year. This was 2020 to 2021. Why that year am I showing you? Because that was a mediocre year. 2023 has been spectacular for the stock market, so is 2024. I can show you the results of that, but they're probably very uncharacteristic. 2020 to 2021, which included that post-COVID period, is somewhat uncharacteristic and somewhat normal. Somewhat characteristic and normal. Okay, now, why did we not get a 208% return? Because we're not good enough to know how much a stock's going to go up. We just know that ticks our boxes and should do well. If we're good enough to know how much it's going to go up, we've only have put our money in that one company, wouldn't we? That's why we didn't get 208%. It was 54. And the 54 came from the tailwind in the market. Okay? Nothing is me. The computer deserves the credit. The tailwind in the market deserves the credit. Because if I really was that good, I would have just said buy Crocs and nothing else. Don't do that. That'd be stupid anyway. I mean, all my financial training would teach me not to say something as daft as that in any event. So whilst you get these individual winners, which are great and sexy for newsletters and websites, please think of the whole portfolio. And the whole portfolio will never do as well as some of the leaders. And if we were good enough to know what the leaders were going to do, we would have picked one stock. And if you pick one stock, you'd be stupid, which is why newsletters are stupid. I've just logically proved the case. Okay, now watch out for this. This is what's happening in the fund management industry, which is why I want the fund management industry to be completely revamped. They're not telling you you're paying them 10%. This is from a fund manager called 91. £10,000 investment. If you cash in after 5 years, which is their recommended holding period, of course it's bloody 5 years, you're going to pay £1,000 in fees. That's 10% of 10,000. 10% is your fees over 5 years. 10%. It's not Alpesh. I thought I'm paying 0.7%. No, you're not. I'm sorry, you're not. You don't know what you're paying because it's been hidden and shrouded, and it's on slide 57. It's an absolute travesty of what's going on. This is a screenshot of theirs. This is their numbers. I didn't create this. It's got bloody pink branding on it. Okay? Yeah, I'm afraid that is what the hell is going on. This is a client. I pulled up this from before. My own pension provided by Legal & General. Shoot yourself. This was provided by my employer. Oh, God. The information was shocking. 20% growth between 2012 and 2022. That's Legal & General. Why? Because, and I've written about this, and Richard Thaler and Daniel Kahneman got a Nobel Prize in economics for showing that people will go with brand names over the performance. If you show them better performance, they will still go with Legal & General with a poor performance because the power of the brand and marketing is that great. And those bloody stupid brands know it. I'm sorry, I'm going to call them what they are. I think they are a fraud. 20% growth. Okay, 20% growth. If I just point you to a bloody index tracker of 500 companies, it's not me, and I just show you, well, there you go. Okay, and the power of the brand is so strong, your first instinct is to defend Legal & General. That's how powerful the stupid arse brand is. So is 40% realistic? Well, no, it's not. It would require all of these factors coming into play. It would mean a tailwind like 2021, 2023, 2024. It would mean selecting high Sortino stocks, high alpha, consistently outperforming the market. There are very few of those. It would mean not the UK, I'm afraid, because there aren't enough. It will mean not emerging markets. I'm sorry, the volatility there. It generally means American. It means you can go into cash in a bad year like 2022 because of the daddy bear rule. It means you really want to monitor maybe once a month, once a fortnight, just to make sure it's not a daddy bear. That happens once every 7 years. It only happens if good years make up for bad, and there will be bad years. Okay, it's not a bank account. You will need high cash return on capital invested because Goldman Sachs Wealth Management data actually shows those are the ones which are the best outperformers. Companies which can generate high cash return on capital that they invest. In other words, they have a printing press for making money. Companies which have a printing press for making money, guess what? Their stock prices tend to rise. Cash return on capital invested. It's not the only factor, though. So it can happen But it's going to require tailwind. It's going to require tailwinds. Are we going to get one next year? I do not know. I don't know whether we're going to have to hold cash and get a 0% return or whether we're going to have this happen again. Okay? I don't know. And of course, you might say, well, how's the year been this year? Well, obviously it's been bloody good because the markets have been good. I can't take any credit whatsoever. All I'm trying to do is remove people out of the evil clutches of a St. James's Place and the incompetent IFAs. Okay. And I can tell you, as somebody who's got more qualifications than any IFA or any fund manager you're going to speak to, the guys are freaking idiots because they're institutionalized and corrupt. They will pick from a narrow gene pool of stocks and then say we can do better than a bigger gene pool of stocks of, say, 10,000 and filter down. They'll say, no, we're only going to pick companies from Europe. We're only going to pick ones with a particular theme. Statistically, institutionally, that's impossible for them to win. Don't take my word for it. Eugene Feynman, Nobel Prize in Economics, for proving everything that I've just told you. Okay? And I'm only saying it because I saw his data. Right? Let's say you plan to invest over 10 years. Let's say you can get closer, and there's no guarantee of this at all. You start off with 100. You plan to add that because you're going to save, well, you'll have $1 million over 10 years. 100, 10 years, 1 million. 10, 100 million. 10, 100 million. 10 years, 100K, 1 million. That's what it looks like. It doesn't go up like that, though, I'm afraid. And it requires patience, and it requires a lack of panic and a lack of boredom. What will happen is it'll go like this. Do you see? It'll go like that. That's what will happen. And why don't people do this kind of stuff? They don't do it because guess when the exponential returns happen? They happen after 7 bloody years. Humans can't think more than, what, 2 years ahead? They certainly can't think 7 years ahead. 7 years to them is forever, just the way the brain works. There's a gentleman here who said he's 70. It's too late for him. Mate, Warren Buffett's 95. You might have 25 more years to go. God willing, you will. If you've got 25 more years to go and you were 25 years old, would you say, no, it's finished for me? I'm 25. It's over. I might die by 50. It's finished. Seriously? Okay, fine. I mean, it's up to you. You should only do what gives you comfortable sleep at night. But that's why most people don't do it. The exponential curve. What is it? D2y over dx squared. The you know your calculus. That's why people don't do it. Yeah, I know you all know what it's called. It's called compounding. Why don't people do it? Put another way, if you can improve your growth rate, you can improve your returns. An increase from 15 to 20 or from 10 to 15 makes a massive difference. You go from having 222 to having 1.6 million. There's a big difference. Same stocks, same people, growth rate, well, not same stocks because the growth rates were slightly different. Growth rates improve, that's what happens. By the way, the difference between 10 and 20 is 2 times leverage, but forget leverage. It's how sneaky people like me do add extra zip. But even if we don't do leverage, that's it. Now, this is my firm fundamental belief. I can teach anybody to invest because that's your average bloody fund manager. And with my big fat mouth, the Financial Times in 2004 said, prove it. So I did. They did a competition and I won. There you go. Oh, well, that was just lucky. It was just a particular year. Okay, fine. Whatever makes you feel better. Give it to Neil Woodford instead. You know what the markets did? They gave Neil Woodford, who, by the way, that year came 14th in that. Jasper the Cat narrowly beat him, but he had a great brand name. There's the power of the brand. Guess what happened? We knew in the industry he's shit. Right? Guess what happened? They gave him $9 billion. That's the way the industry works. If you're shit, they'll give you more money. Why? Well, it's like unions in Britain in the 1970s. You do not want hardworking people working in a union because they're going to show up everybody else. Same thing in finance. You do not want quality getting money because it'll show up everybody else. Keep it mediocre. Everyone can keep earning fees. Somebody good turns up. Whoa, don't give them money because they're going to show the rest of us up. Essentially 20 to 40 stocks and then the rest in cash. So you might decide to have 10% in cash, 20, 30, 40, 50 in cash. And then whatever's in stocks would be about 20 to 40 stocks equally weighted. Keeps it simple. Keeps it absolutely simple. These are some of the big brands. Why do they use people like me to communicate to their audience and pay us to communicate to their audience? Because I think brands are having a problem communicating with their audience. I think there's a genuine problem that brands have. Barclays, I'm very lucky. They did my book launch. If you'd like a free copy of the book, I'm sorry I've overshot this. That's who I am. I've written 18 books on there. They're in a variety on this. What do I think about crypto? The same thing I think about modern art might be worth something, might not be worth anything. I don't know. I know as much about crypto as I do about modern art. That's the Goldman Sachs slide on cash return on capital invested, basically cash flow after capital. If you can create a money-making machine, which is literally what cash return on capital invested is, your stock price is likely to get 30% per annum. Okay, that's from the quantum database Goldman Sachs research. The reason I look at data is because never, ever, ever believe what you think. Never believe what you think. Instead, go for data. And that's how money's made. Numbers. I don't take my word for it. Jim Simons, Warren Buffett, data-driven. If you're not going to be data-driven, then you're speculating and gambling. If you want to speculate and gamble, it's entirely up to you. This is a typical portfolio we were sent by people, and we put it through our analysis, and you can see the massive gaps. There's very little green on there. That's a typical problem of somebody's typical freaking portfolio. Bruin Dolphin, another red flag for me. I'm not going to be polite about these. Okay, spray and pray. They will put it into funds, and the funds will put little bits of money into 100, 200 companies, and then they wonder why they don't get growth. Mathematics is why they don't get growth. It's as simple as that. Give me 10 minutes. Well, actually, not even 10. That's what we do. Okay, if you want to do it yourself, you can do it all yourself. Okay, these are four of my past. Three past secretaries and somebody who worked for us in venture capitalist, Kanira. So Naomi was my secretary. She worked for me for 2 years, straight out of university, 2 years worked for me, and then moved to Newton, and then moved to Polar Capital. And I was looking up her performance recently because I thought, well, wait a minute, she worked for me, so let's see what her performance is like. Gone to the dark side of retail fund management, picking from a small group of Japanese companies. Guess what? Your performance is going to be shit. You've got to look at all 10,000, and that was proof of it. If you don't listen to what I say, Kirsty's fantastic. She's gone on, after being my secretary, gone on to be a solicitor. Susan is now head of international communications at Wells Fargo. Fantastic as well. Really proud of them. Kanira works in venture capital, private equity out in Europe. But yeah, if you get paid well. You get paid well. Newton pay far better than I do. And so did Polar Capital and everyone else. And they pay you to keep writing nice monthly newsletters, but you cannot beat mathematics. If you are picking from a narrow gene pool of companies, you're highly unlikely to perform well other than through good fortune. Eugene Famer, Nobel Prize in Economics. Okay, so when we get people who want us to do it for them, we give 99% of stuff we give is free. Go to campaignforamillion.com. You'll see all the free stuff, all the tools, all the apps. For the 1% who want us to handhold you, and we want to create a different kind of asset management company. 20 years ago, I set up a hedge fund for institutional rich clients. That's not purposeful meaning work. We've got offices in Zurich. If you're out in Zurich, I think one of you were there, go visit us. But for the retail clients, what I want them to do is keep hold of their money, not pay weekly, monthly, annual fees. We want to give them the data and the hand-holding and all the stuff that I teach through my books and all the media and all the lovely things hedge fund managers like Bernard Opperty and Merrill Lynch MDs have said about us, and convert all of that into what I call the Great Investments Program. That's for the 1% who want that mentoring and handholding, want the data, want us to do all the work for them, but they control their money and they only pay one off. I want that to be a floated company eventually. I want that to bring down St. James's Place and the wealth management industry. Okay, that's my ambition. If anybody's wondering what the ambition is, and when I do webinars, I take on 10 people at a time. I wish I could take on hundreds, but there's a quality control issue because I'm doing the mentoring. We've got a great team: Simpi, Shireen, Paresh, Liam, Judy. We've got a great team helping me. But by giving them access to the stock database and all of this, plus the calls with me, plus all the education they could possibly want as well for life. But most of them just want to speak to me, get the data, create the portfolio, we run the numbers, and then they're happy. And then each year, tot over it. Then that's it. Then the 1% join. Everybody else, you've got all the free stuff, feel free. But for the 1% who want to join, and it's 10 at a time I take on, I want to try and get to about, I think initially it was about 350. I think I want to get to maybe 500, maybe 700 before we decide the next step. My wife was talking to Sequoia, the venture capital firm, about 2 weeks ago, and they asked about what I do. And I had to make a decision whether or not to take venture capital money or speak to them with view to taking venture capital money this early. I don't think I want to take it this early. I think I quite like the idea of owning 100% of it all for now. But the idea is you take control, you learn how to do it, and that's where you go to do it. I hope you've liked this webinar. Good for my next 20 years. Thank you, Graham, on that. I hope you've liked all of this as well. And we've had, and it's probably the longest live that I've done in a long time as well. So I'm going to answer any questions people might have on all of that. Here we go as well. And any questions on the markets as well that anybody might have. We've got some great reviews. If you go to alpeshpatelreviews.com, alpeshpatelreviews.com, you'll find the reviews there. Okay, any tools, any questions, let me know. I really want to disrupt the financial services market. I think it's bloody appalling what the market does, how it charges fees for piss poor performance, when self-evidently it's a hell of a lot easier to do a hell of a lot better. It's as simple as that. Jacob, we've got a lower tier. For those who don't have the capital, we've got a lower tier. It's free. The lower tier is free. You can't get cheaper than that. Have a look at all the free stuff at campaignforamillion.com. We have 2 tiers, membership and zero. I can't get cheaper than zero. So yeah, absolutely. And I do the free webinars. The books you can download for free as well. There you go. The book for free as well. Any questions, let me know. Thoughts on Meta? I covered that earlier. It's volatile. I continue holding it. I don't panic. I don't get bored. SJP charged me 2.5%, grew my pension by 2.5% per annum for 7 years. They're appalling. St. James's Place are absolutely bloody appalling. And they get paid a lot of money for people who work for them to pretend that they're not rubbish. Okay. Thank you, Jacob. As well. Thank you, everyone else. Now, we got somebody from Washington on here earlier, so thank you for that. Thoughts on Apple and Amazon into the earnings? Jacob, that would be trading. I hold them. I have no problems holding them. Everything else is noise. And that's the attitude. If they fall, I might buy more. I couldn't care less what happens going into earnings. I'm not trading earnings. Even when I'm trading, I'm not trading around earnings. It's just a gamble. Retail clients love it. Brokers love earnings because it gives them an opportunity for people to panic. What does Warren Buffett say about earnings? Ignore them. Ignore them. Okay? As well. All right? So that's the thing. I'm going to roughly go backwards on the various slides on here. What am I missing? There's something I just saw something. Here we go. Thank you. Supermicro is, I think, incredibly volatile, isn't it? If you like the volatility of Supermicro is fine as long as you've got a portfolio. Let me explain something on portfolios. I'm going to show you something. I don't know if you can see where I am because I'm quite small on the images. If you've got 2 stocks, both averaging, let's say, 15% per annum, so they're not even NVIDIA, they're just mediocre companies averaging 15% per annum. And you might think, well, which shitty companies are doing that? But just assume they both do. And one of them goes up when the other one falls, but they both average 15% per annum. Then at the end of the year, if you only picked any one of those, you'd have some volatility and a 15% return. Okay, but if you put both together, because one went up when the other one fell, but they both generate 15% per annum, you'd have 0 volatility and a 15% return. So by adding 2 risky assets, which were moving inversely to each other, but both averaging 15%, you manage to get the same return for less volatility, i.e. same return, less risk. Harry Markowitz and William Sharpe got the Nobel Prize in economics independently of each other for that discovery. That's called the efficient frontier. It's called portfolio optimization. IBM recently did a quantum computing portfolio optimization with bonds about what I'm talking about. The point I'm trying to make is you're talking about an individual stock. How that stock looks is a bit like saying, what do you think of sodium or what do you think of chlorine? I think it could kill you. But then you didn't tell me that you've also got it as a compound. Sodium and chlorine put together becomes salt, benign. In the same way, Supermicro might be a really good diversifier to other things in your portfolio. If you do not think portfolio, but you think individual stocks, instantly I know you are taking greater risk than you probably want to, and you're gambling and speculating. But sitting in a portfolio, that might dampen the volatility of the overall portfolio and still give you the upside returns, like the example I gave you with just 2 stocks. That is why portfolios are important and is why money's made. And Markowitz, Nobel Prize, because what he showed is if you get in a portfolio a bunch of uncorrelated assets, that is how the super rich become rich. A bunch of uncorrelated assets. The other way the super rich become rich is they fill in a lottery. Okay, there are 2 types of wealth in this world. The lucky ones, which are, think of a lottery, or you happen to be in the right place, right time, and discovered oil. Okay, and the other one is holding for a long period of time uncorrelated assets. That is the Warren Buffett. That is the big hedge fund like Jim Simons. Retail clients in IFA funds don't fall into either bloody category, which is why they never get money. Okay, those following newsletters really piss me off because they're just really going for, as Warren Buffett said, breathless freaking headlines. Thoughts on quantum ETFs? Too narrow. Literally, you're picking from a small, narrow gene pool. Why would you not look at individual quantum stocks within the ETF, within a portfolio of non-quantum? What you're thinking is, if I pick a UK fund, a value fund, a growth fund, a quantum fund, an AI fund, surely putting all that together gives me a diversified portfolio. No, it doesn't. It's like saying I'm going to pick something really crap from a narrow gene pool here and something crap from another narrow gene pool there. Surely mixing those 2 together gives me something beautiful. No, it doesn't. It gives you shit squared. Okay? What you should be looking at is saying, okay, which are the best companies meeting the value growth income criteria? Whether they happen to be in quantum or otherwise is neither here nor there. And if they're in quantum and you wanted it, fine. And then you put that into a portfolio and say, how's the whole portfolio doing? It's the portfolio that's going to make you money, not an individual stock. Unless what you're asking me is, Alpesh, I'm incredibly risk-loving. I only want 1 stock, and I want to blow my brains out with just 1 stock. Please, if that's the case, great. Bitcoin, look, if you've got anything which is volatile with an uncertain future, you need to elongate your time frame unless you're looking for a trading strategy. And I'm assuming you're not looking for a trading strategy. If you are, I've just given you one to do with Daddy Bear's exit, rising MACD, buy. Okay, there's your entry exit trading strategy. For crypto or anything else, what you would otherwise do is increase your time frame if you truly believe in it. Now, if I increase my time frame on crypto to 5 to 10 years, either I'm going to end up with 0 or I'm going to end up with a large number. And I don't know which it's going to be because I'm not a bloody expert on crypto. It's that simple. If you want me to tell you a secret story about how Ripple is backed by Andreessen Horowitz, the biggest VC, or one of the biggest VCs in Silicon Valley, and their people are now stationed within the Trump White House, and they're really going to push for Ripple to move ahead. And the Bank of England did analysis on using Ripple to transfer money. I can do that. And everything I've just told you is true. It's a sexy story. Guess what? It's not going to move the price of Ripple until it moves the price of Ripple. It's a speculation. It's a gamble. Go ahead. Go buy a Van Gogh painting as well. You might do better with it. So what I'm telling you is a product of both the limits of my knowledge, which you really ought to take on board. You know, it's like asking me, what do you think about a T-nut plumbing hub? You're probably asking the wrong guy. Right question, wrong guy. Okay, is what I would say. Okay, guys, I'm going to go now. David, you may remember I joined Santango. Can I get? Yeah, David, just email me. You should have my email, shouldn't you? I don't know which David this is. Oh, yeah, I remember. David, yep. Please email me. And I'll try and remember to email you back as well. You should have my email. Okay, guys, thank you very much. I'll try and do more of these. I think on TikTok it sort of works. I'll make sure there's a dual camera in future so you can see me as well. All right, so TikTokers, goodbye. Lots of diamonds. I've got 112 diamonds on the talk. So thank you for that. And let's hope 2026 is like 2025, because if it is, bloody hell, it's going to be good and fill our boots. Sooner or later, you know, we're going to get a rubbishy year in the market. We're going to have to sit on our hands. So don't spend all your profits, because you might need them to spread over 2 years. Do you see what I'm saying? Okay, it's a bit like me saying, hey, you got a bonus this year in your job. Don't bloody blow it. You might be redundant next year. So please be sensible. Spend less than you think you've made, and you've not made anything until the money's sitting in your bank account, as my grandma used to say. Wise woman. All right. Thank you all very much. He says, trying to work out how do you close exit now. I'm going to end the live on the talk, and I am going to take it there. Okay, everyone. Thanks very much. And there we are. Oh, it's got darker, hasn't it? Any other questions, just email me. Have a look at alpeshpatel.com/links and the like. I hope that's all been an enjoyable session for you all. Sorry, it's been an extra long one, given that I don't think I've done one of these for a while. So I hope that's been good. Okay, thank you all for being on here. Cheers. Just check the final bit of chat. Alpesh, forget there's a minimum 100k required to work with. Chaz, no, actually, funnily enough, we've got people who've got less capital because they know they're going to get more over the years. Do you see what I mean? So you could start, I mean, we've got people with less than 100 because they're in their 20s or early 30s, and they say, well, I know I'm going to be earning more, and I'd rather join now and have the benefit of the education, and as it increases. I mean, my son technically benefits from it, and he's only got his junior ISA amounts each year. So he's still, I think, still under 100, if I'm not mistaken, or he might be reached 100 now, only just reached 100 now at the age of 7 with his allowances and the stock market gains since he was born, which is 2018. So, what I would say is you've got to look to the future. So I'd say that's perfectly fine. All good, all good. Yes, sorry, Graham. Do you know what? I was traveling to Zurich. So we've got a private equity fund, which you'll all know my asset management background. We've got our offices in Zurich, so I've been flying a bit back and forth. So I've not been doing the public webinars as much, though I should do more of them. And I've been doing more just the ones for clients. Actually as well. So that was the only reason. I've thought about Paresh doing them instead, but people always want me. And the rest of the team are not so vocal. Maybe I should train up an assistant to be more front of camera. But thank you for all of that. Okay, everybody, thank you all very much. I'm going to call it a day. Thanks very much.